Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers, ranging the spectrum from emerging to established franchise VCs. I'm flying solo today as my GP co-host Nick Charles and his wife just welcomed their first child into the world. So it's a one-host show today, and in the meantime, we wish Nick's family all the best. Today, I'm excited because we're going to talk to Stephen Bluestein, a fellow LP who just started a new role as partner on primary investments at Adams Street Partners. Many LPs have direct investing experience. Most LPs do not, though, have experience at firms such as Bessemer, TCV, and Light Street, and then decide to become LPs. And given the impressive portfolio of both Packard Foundation and Adams Street, Stephen has a unique view on some of the top funds in today's venture landscape. So beginning with Stephen, we're starting a couple pod mini-series on a topic I spend a lot of time thinking about, franchise funds. The core tenets of one, what it takes to become one, how you recognize one early on as an LP, and how many are in the market right now, and so on. Which, of course, nicely tees up the burning question for this pod. What does it mean to be a franchise fund? How do you get there? And perhaps most importantly, how do you stay there? Let's talk with someone who knows. Hey, Stephen, good to see you. Thank you for coming on Origins.
Oh, I'm so excited, Beezer. This is my first podcast I've ever done, and I'm so grateful for the opportunity to do it with you.
Well, I'm really honored that we get to be your first. I didn't know that, but that's super awesome. I was super excited to talk to you anyway, but now it just creates a little extra, and we'll make it wonderful so you enjoy podcasting and come back. Is that okay?
Oh, yeah, absolutely. I'm not trying to become a podcast star per se. I'll leave that to you and others, but I am grateful and I'm super excited to have this conversation with you.
Awesome. And the topic we're going to dig in on is franchise funds. And I've just been so eager to have this conversation. It's something I think a lot about, even including what's the definition, right? Everyone sort of talks about how great it is to be a franchise fund, but it's oddly not even a defined term because I am a geek. And I was searching the internet in different places and it's not defined yet. LPs use it and GPs use it. So I'm ecstatic to be able to just break down all the parts of what it is and why we love them and maybe challenges in staying there with you. But first, I wanted to start with you. Yeah. And congratulations on your recent move to Adams Street. I think you're officially settled in now, yes?
I kind of know where the bathroom is. I could see it over my shoulder. You know, I've got a key card. They let me in. So yeah, I think that's considered settled in today's modern world.
Excellent. So could you give us your bio in any path that you want to take it, whatever feels right? But if I could ask you to make sure you include your process from direct to indirect, at least as some components, I think I remember when I became an LP, everyone said direct investors never became LPs. And I thought that was weird. And I think it's really helpful actually having that background. So hearing that process to the Packard Foundation and then obviously talking about your new life at Adams Street would be great.
I got my big break in 2007 when Bob Goodman at Bessemer Venture Partners made me an offer to come join Bessemer Venture Partners. And this was again in 2007. And, you know, if you rewind the clock on the venture industry at that moment, you know, we probably could count on our hands the number of firms that were really, you know, backing new, interesting startups at the time. You know, Andreessen Horowitz had not been born. You know, many firms that we come today to know as some of the iconic firms like Y Combinator had not been born. It was a very small, niche-y craft industry. And I got my break, you know, joining Bob and Bessemer, worked with him for about 3.5, 4 years, really learned the craft of direct investing, you know, really learn about what it means to be a board member, what it really means to really learn how to take ownership and work with these companies. Mm-hmm. But I'll fast forward a little bit. I was at TCV for about 4 years as well and got really lucky joining a really early crossover fund called Light Street Capital, started by Glenn Kacher. Glenn had been at Tiger Global back in the 90s working for Julian, and he had hired one of my close friends, Jay Kahn, who had that I knew really well, and he was employee number 2 there at Light Street. And the idea was to build a Tiger Global for the West Coast, leveraging our venture knowledge and ecosystem to make public and private market investments, but largely at the time when I joined was public markets. But leveraging that DNA of like understanding that great companies can be born anywhere, leveraging the idea that great founders typically build their companies, become public companies, and backing those founders over long cycles was a great way to make money. And just having that connectivity to the Valley and knowing that lots of companies were being born in the Valley that could disrupt the public companies that we saw on the stock market today. But having that fabric of Silicon Valley-ness to our investment strategy, we felt really differentiated us.
Oh, I love it. We are so simpatico because we geek out on venture. And yes, this is going to be awesome. Yeah. I'm so excited.
No, I think firm building, I think, great investors, could exist and they could be, solos or non-solos. And I'll say that many times today, joining the Packard Foundation. If you really think about it, such an iconic, wonderful organization built over 60 years now. It's kind of crazy. Packard's been around the foundation for 60 years. And then the investing team is just, top decile in terms of how they think about manager selection. I feel like I just love this industry too much. And as crazy as the industry is, it is all encompassing in many ways. And so really got excited to join Adams Street, really centered around the opportunity to really double down and triple down into venture. And what I mean by that is explore the full range of venture, not just being an LP and being on the LPAC of, really interesting funds, but really partnering with them and thinking about how their business is evolving. But I'm excited to join Adams Street after my time at the Packard Foundation is to go deeper in venture and really geek out to thinking about these firms in different ways and how you could be a partner to them over many cycles.
Amazing. Thank you. I thought I knew your background and I just learned so much more. So that's awesome. I love those moments. And I love the fact that two geeks can dig into this because yes, it'll make for a rich conversation. And much like you, we like to take things apart. And so I know I sent you some numbers in advance and we actually been working on rerunning some of our venture portfolio stats to see if the last couple of years have changed things. Good news, bad news, not really. I think the cohorts most recently obviously haven't had time to do too much because it's just been recent. But if you'll bear with me, I want to go through and break down some numbers. And I'm doing this because I think for folks who listen, they don't always have the context within which to understand how LPs then parse the market. And hearing the numbers, I think gives them sit in our seats just a little bit. So I know you know these, so just bear with me on this. Let me start with the meta. We heard a lot of people talking the first half of this year when you saw, I don't know, almost 50% of the money raised in 2024 through first half was raised by GC and A16Z. And everyone was like, what? That's crazy tunes. And it is a little crazy. But if you think about the context of LPs and where you concentrate capital and the power of franchise names, it starts to make more sense. And so if you back way up, we look 1995 to 2014 to do our main cohort data analysis because those funds have had enough time to raise enough vehicles that you can kind of get your math to work. And if you just look at the funds that made it from 1 to 4, so emerging to established, it's less than 20%. It's about 18. So that's grossing up 1 in 5. Yep. And if you look at the ones that made it from fund 1 to fund 8, it's even fewer. It's 3%. And then you and I are going to do, so get ready, the franchise math name game. And I've done some making lists up myself. And we think let's just be optimistic and say at any given time, because I think they, over 20, 30 years, they might change, but there's probably 30 or 40 quote unquote franchise funds investing actively in the market at any given time.
Yeah.
And in the background to that, if you go with PitchBook, who says there's, call it loosely speaking, 10,000 active funds. And even if you call that to the number I shared with you, which is maybe it's more like 4,000 to 6,000 if you take out ones who aren't really so active. Or if you try to focus on core funds, because when you think of a franchise fund, there's usually some large core vehicle, right? So even if you narrow all this down and you take out biotech and you take out corporate, you take all that out, you're still talking about less than a 1% of the venture funds actively investing at any given time are franchise funds. In that, and wait, there's more. Then you say like, okay, so when you and I are looking at investing in franchise funds, and it's less than 1% of the active investing folks, like, what does that mean for how many funds we look at per year? So I just reran this. If you look at 2014 to 2024, there were on average 200 funds 1 through 3, so emerging managers that closed in any given year. So that means thousands raising, 200 on average closed every year. And then if you look at fund 4 to 6, which I don't know if we're going to call that franchise, you get to decide. There's like 40-ish that close every year. And if you look fund 7 and on, to your point about when does somebody get to be considered franchise, there's on average like 20-ish that raise every year. So it's actually a really small target market. And if you're an LP that has only so much bandwidth, do you spend your time looking at 1,000 emerging managers to pick one, or do you look at 20 funds to pick one? So I know that's a lot of numbers, but that was the context, because I think we throw around this term franchise and everyone has their own slightly different definition. But that's where everyone wants to end up as a VC, because it ends up being this hallowed ground of you've made it. And theoretically you stay there forever. I don't know if that's true. You and I will discuss.
I was trying to think about what defines a franchise fund a little bit. And without going to like the specific checkbox sort of thinking, I'm going to sound a little academic here, so apologize. But like, what really is a franchise? Like, forget about a franchise fund. Like, you and I could list all the McDonald's and the Arby's of the world, or pick your favorite franchise. But like, I started actually looking up the definition of franchise. And one of the things that struck me as I thought about this question was like, what makes a defining franchise within any industry? And obviously you can like look up the actual definition and you could sort of think about it a little bit. But like, at its core is this idea that there's a brand, right? And there's a brand that people recognize. And I think that's like definitive across, different industries. And we could talk about venture, but like the fact that there's a brand, I think, is super important, and it stands for something in the market. And then the question is, does it stand for excellence or not? It's obviously a question, but it has a brand. I think that's a really important component to any franchise. But more importantly, when I think about franchise, like if you or I were to, Beezer and Steven were to start a McDonald's franchise or something like that, like what would we be signing up for? We'd be signing up for this idea that like a lot of the raw clay and the ingredients were already done by McDonald's, and then you and I were applying capital. We'd open up our little shop in Sand Hill Road, and we would be successful. We'd be successful in theory because there was a whole bunch of things that were done by other people that allowed us to come onto this platform and be successful. And that notion that like someone can join a franchise, become successful because of a bunch of other, latent things that happened before them. Kind of actually applies to venture as well. Because if you think about it at the core, which I try to think about, is like what has made, Andreessen Horowitz successful has been their ability to integrate new people to their team. They have a great franchise and a brand started by Mark and Ben, but at the same time, new partners can join and they get trained up on what it means to be an Andreessen Horowitz partner. And then when they go out into the marketplace and represent them, people know what that means. People know what it means, their engagement as a board member, how they think about ownership, how they deploy capital. Those things come with them in the same way that what it means to start a McDonald's franchise means to that new franchise operator. And I think that it doesn't have to be this way. It doesn't have to be this idea of like stamping out new things over and over again, because obviously there's models like Benchmark that aren't stamping out and growing, new partners all the time and growing. But the element that people can join the platform, and I use the word platform not in a bad way, just like the idea of this firm, and they can take their own special idea about how they want to, practice the craft of venture and grow from there because there's something that's happened. And I think that's an important piece to me, because talent acquisition, talent, being able to retain talent. I mean, we can debate this probably on end, but like that is the most core piece of longevity in venture is the ability to attract talent onto your platform, retain talent over long cycles. Because if the idea of venture is right tail, backing great companies, and it's done by right tail venture capitalists, right? Being able to attract them onto your platform in different unique ways, again, different models for different firms. We'll go into Bessemer a lot because I worked there. Like everybody starts as a senior associate VP. They have never hired, I don't know if never is the right word, but rarely have ever hired a lateral hire onto their franchise. So their franchise is growing talent from within. That's a very different model than Benchmark's model, where a senior partner who's built some level of track record comes onto that franchise and learns how to be a Benchmark partner, but takes their own secret sauce. And so, there's different models, but what I think about what it means to be a franchise is you have some sense of what your model is, and you have a playbook that you can grow and perpetuate. And the firms that typically don't succeed didn't think about that part of their business. They just thought about investing.
Oh, there's so much to unpack here. Yes.
They didn't think about the firm building aspects of investing to sustain themselves for longer periods of time. That's what I would say. But I know everyone can define it differently. That's why Benchmark and Andreessen can both be franchises, but have totally different models, because they both thought deeply about their competitive advantage, their moat, their firm building aspects. And they're totally different, the farthest ends of the two spectrums in terms of strategies. But we would both agree that one is a multi-platform franchise and one is a single platform specialist, franchise. And so I think we have to unpack those two different strategies. But before like that, that's what I think about what's a franchise. To me, it's this ability to have an operating playbook, know what makes you special, double down on that with talent acquisition, and then keep that talent in house such that you can grow and get to the Fund 8, the Fund 9, and have the generational transition that has to happen in order to have a franchise. No franchise can ever, I don't know if I say never, but it's like hard to imagine a franchise that didn't go through some level of generational transition. And so doing that well is key.
Can I talk about two parts that are implicit in what you're talking about, which is how long does it take to become a franchise? I've been weighing the importance of succession as part of the definition. Benchmark has had succession and been successful at it. Greylock's had succession and been successful at it. When you're thinking about franchise, how do you think about the time in which it takes to become that, right? Because there are some emerging managers, I could argue, where it's really clear what they stand for, but they might not have the time to train people.
Yeah.
And then, yes, how far in the succession do you have to be? And I don't think there's a perfect answer, but you're clearly, you've a sense for the weight of it when it's been achieved.
It's a really good question. And I think you're right. I think if you think about, there could be franchises that are solo GPs. Well, there's no succession other than just turning out the lights at the end of the day. And so that would violate the notion that there has to be succession, or some transition in order to be considered a franchise. So I think that's why when I think about it, it's like there's different modalities of franchises. Eli Gill is building a franchise, and he will, when that doesn't become no longer an investing organization, it will probably go with him. Will we look back and say that was a franchise in the classical definition of what we like to think about? Probably not, but it will have the brand. It will resonate in the market. It will be on Fund 7 or Fund 8. So it'll have the heuristics of a franchise, but it'll be missing that piece of long-term succession. Unless he brings on another partner and it grows to become something beyond that. But I don't know if that's going to be the case. And so I do think, if you are playing, in the game of branded Series A with multiple products across multiple geographies, you're going to run into that GP transition wall, that succession wall. And I think you need to have made it over that hump. And if you think about, 7 funds is a pretty good number to think through, because if you were raising under the normal cadence of funds every 3 years, but that sort of became 2 years in the last cycle. But, that's a 15 to 20 year run as a firm.
Yep.
At that point, unless the GPs were 25 when they started it and, or ended up, and I think there's going to be a bunch of those that will run into Fund 7 at age 40. That's not going to be, there's a new wave of GPs that are starting early that may build franchises in their early 40s. But I do think about Fund 7, I was thinking when I joined TCV, and I have a lot of respect for what Jay and the team built there. It was clear, probably I wasn't there at Fund 6, that there was something happening and they were growing into this model. And then that big step up from Fund 6 to Fund 7 in terms of capital, growth, strategy, team. They didn't have to go through the succession yet. They're in the middle of that maybe a little bit now, but there wasn't that feeling, but it was kind of Fund 7. And it was kind of at that moment where there was a kink in the curve, where the fund really changed how it had to operate in terms of deploying capital at scale, doing more things. So not to punt on the absolute because it's sort of hard to know, but I think every fund, will go through that cycle. I probably should have looked back and saw when the big transition happened at Benchmark, but it was probably around the fund 5 or fund 6 level. So it's somewhere in that zip code, but I think every fund's on its own journey, right? It's kind of when you started. Emergent started much later, right? Mm-hmm. The founders were much later in their careers. And so that transition, probably happened really around fund 5, in their life cycle, partially because they started the firm when they were a little bit older and brought on people like Jake and Joe and Santi and Kevin. And now they're in the middle of that. And so that was probably fund 5 when it started, but they just are, fund 7 right now. That's kind of when the cutoff mark is. It's probably like a new firm going forward on the go forward basis. And so it's somewhere in that zip code of 5 to 7, but really depends on, kind of when you started your fund and where that life cycle was. Because I think there'll be a bunch of people who start much earlier, and therefore the numbers may not mean as much.
No, 100%. I have long thought, and the reasons we obviously look at graduation rates between funds 1 and fund 4 for the emerging established, but then also in the capturing the 5 through 7, because that's where succession hits. That's where track record becomes seen. And I would bet money on this. That's also why you see things drop off, because just because you make it to fund 8 doesn't guarantee you franchise status, but it does mean you've probably dealt with some of these things and have made it through that, whatever gauntlet we want to call it. But so on this point, given your experience, do you think there is a minimum viable performance metric to be considered franchise? Because, and I'll just spice this up by saying it is incredibly hard to have multiple 3x net funds in a row. So I don't think LPs presume that to be true, because some years are just, let's just like 2021 is going to be a tough vintage. 2022 was just a tough vintage. So what have you seen, if you can share things that you've seen, or what do you believe based on things you've seen, if we need to keep it a slightly more obscure, about the performance that has to be true for LPs to really sort of buy into the franchise-ness?
We always talk about this with Neil Shah, one of my favorite LPs to chat with. It's like, you don't get to invest in the top, the fund, the top decile, top quartile fund every vintage. You can't just like move your capital between all those things. Like when you invest in a fund, you're putting your money over typically 3, at least, 2, but more likely 3 or 4 funds. And so what is the total performance over that fund cycle that you should be really thinking about? Because, like you said, like you could get a 20x net fund in fund 1, and then fund 2, it could be less, and fund 3 could be different. And so but on aggregate, have you invested, equal weighted dollars across those 3 funds? Did you get a top decile fund? I think that's the measure that I think about. But it comes back to, do you believe there's a right for them to have a, sort of 10x fund, from a fund construction? And obviously that's, gone maybe away now with the capital that's in the market, of course. That's not really believable in the context today for the traditional larger full stack funds. If anyone has any differing point of view there, I'd love to hear how, people are going to generate 10x net funds. I don't think anybody thinks that that's the goal. But when I think of someone who's transitioned to become a franchise fund, they've had one of those lights out funds, because usually that, and the question is that sustainable, and how does that, perpetuate? But usually what it really means at the core is that they were picking in a market, and they picked well. And the founders that come out of that cohort that they picked well for are going to be future references and future data points for entrepreneurs to look at. Because at the end of the day, the way that you think, the way at least I think about the arbitrage in venture, the arbitrage is getting onto the best cap tables of the best companies with the best founders, right? That is, at the end of the day, we can say it, and that's sourcing, picking, winning, and how do you get there and all those different elements. But if you don't have the ability to get onto the cap table of the top founders, it is hard to generate exceptional returns. And when I look backwards, and again, backwards is a pretty poor metric in venture because it really is about the future. There was something about how they're able to get onto the cap table of those exceptional founders. And so having seen, now, can they perpetuate that as the fund size grows, as the team grows, right? That's what makes a franchise that sustains, is this focus on getting onto the best cap table. So again, I think of Andreessen Horowitz as a franchise, but I don't think I'm expecting 10x net anymore. But what I'm really saying by that is that they have found a way to get onto the best cap tables. And that's true of Excel, and that's true of Index. I think of them, it's true of Bessemer, but it's also true of Benchmark. It's also true, I think, of Emergence, where they've have a way that they have a process, a team, a strategy. Again, looking backwards, you could see success. Looking forwards, they have a theory about how they do it. And again, the question is it a sustaining franchise will be the ultimate question. But when I think about a franchise, they put those pieces together of one exceptional fund, because I do think you need to have that in order to sort of know whether or not, you're able to really identify those best founders and get onto those cap tables. Because if you've never done it, again, it's sort of hard to make that argument to me. But again, by the way, it doesn't mean that that fund won't be successful, that won't be good IRRs, there won't be good TVPI, there may be great DPI, like there could be great returns there. But I think to graduate into that franchise, you've got to have that exceptional fund somewhere over the course of your life in order to sort of show that founders want to select into you. Because I think it's part of the brand.
Yes.
I think founders look at other founders that are in that network of great firms, and they say, I want to be like them. And so the brands are hard to really have that unless you've had the abject success. And that means you're probably going to have an exceptional fund unless, you started out at a $2 billion fund, then maybe it's hard. So it's hard to put like a number on it, but I think it's that lights out fund that you and I all look at and say, wow, there was something they called lightning in a bottle. Chris Sacca's first fund, this sort of like, wow, like now can they perpetuate that? Can the fund size outgrow their ability to deploy capital thoughtfully is the next set of questions. But I think it's hard to just, bootstrap your way into a franchise without a exceptional fund, because that means you weren't on the cap table of exceptional founders. And that's really, I think, what defines it.
I want to follow that thread that you picked up on, which is you get your exceptional fund. And then how do you successfully make that or sustain yourself as a franchise? Because I know of funds who had an exceptional fund, but it was kind of a one-off. And maybe for them, and I would say this with a lot of respect, I think some of them were just fine. It was a life-changing amount of money for them. It was a one-off. Maybe they've exited the market based on that. Or maybe they've gone back to doing whatever they're doing, but their fund name doesn't live in the psyche of founders. Because when you ask around, you don't hear it. And I know they're exceptional investors, but you don't hear people talking about them. And then the LP question is, does it matter? Because if they find the 20 founders in any given portfolio time frame, does it matter if the other thousands of them don't? I don't know. But you and I, you're nodding. Like you and I have seen the same thing where it's not, people haven't always managed to capture that lightning in a bottle. So what have you seen the franchise funds do? And then the implicit other next question is, keep doing, or they might lose their franchise status. Because I do think some have over the last 30 years as well.
Well, I think it really comes down to kind of what we were talking about earlier, which is you have a theory about why that success happened. And some of it can be luck, to be clear. But like I was just on a Zoom with an emerging manager about to raise fund 2. And we spent 30 minutes on the call talking about where are their networks of success? Where are their compounding flywheels for them? How do they think about it? What is their structural advantage? Again, back 20 years ago, the industry was very different. And so maybe those things didn't matter as much, right? The old days, people drove up and down Sand Hill Road and had to go speak to all these venture capital firms, and they were the tastemakers. Right now, it's a different business, right? You got to be outward facing versus, totally inward facing. But more importantly, I think what defines the firms that have made that jump from that one iconic fund into a franchise, they sort of thought about systematizing and thinking about what it was, why that was, unique, or what were the elements that made that happen. And then started to think like, well, is that a repeatable thing? Like they questioned their own success and sort of said, hey, like, sure, this seems to be working. But like, what do we need to do? What is our mode? How do we think about how that's going to sustain? And just like any company in the world, right, it's a competitive market, right? Founders do have choices, right? So that's the idea that you can get onto the arbitrage is getting onto the cap table. Founders have choices today, much bigger choices than they've ever had. And so the question is like, what is, when those firms, I wasn't there at any of these firms in the earliest of days, but like, what did they think was their competitive advantage? Did they double down on those things? Again, to me, it's people. And so how did they think about either bringing in people, sustaining people, growing people, and what was their market message to the market? And was that market message getting disrupted? And if it was, like, how do they adjust to that, right? And I think that's why we go back to the generational transition is the big hard thing, because if you look at a lot of firms that have done it well, they figured out that piece. It didn't just happen, right? So it goes back to this idea that like they thought about their moat, they thought about their right to win with founders. And then if to the extent that wasn't sustainable, they figured out how to get that to become more sustainable, just like any business owner, right? If I were starting a fund today and I put out a shingle, like what would that shingle stand for in the market? Well, it could just stand for Steven, and that could be okay. But if I wanted to sustain and be a franchise, I probably need to think about talent. I probably need to think about strategy. I can't just be, in the market with a flag saying Steven's Venture. And so I do think, to go back to your question more pointedly, I think they thought about it. I think they thought about their firm. They think about it relentlessly. The processes, the people, the moat, the sustainable competitive advantage, how they double down on it, how they block out the noise of FOMO of what other people are doing, right? The classic benchmark example. And there's articles written about the death of benchmark. And then, of course, they continue to do really great. And they just continue to believe that their model works and they perpetuate their model. So to me, it goes back to knowing who you are and not doing unnatural things, without first principally thinking about how that growth is going to sustain excellence, right? Because everyone's been raising, so the big secret, right, is everyone raised opportunity funds. And Brajesh has already heard me say this in my 4 short weeks here. Like, what is the point of this? Like, what are you doing? And there's lots of reasons to do it. But is it first principled? Is it about strengthening the franchise? And if your franchise is excellence in A and you're doing B, if those 2 things don't create separate flywheels that spin together and work together in their own way, then it doesn't feel like they're being built, from a first principles. And it doesn't mean they won't be, to be clear, it doesn't mean they won't be successful. They can defy my notion of what I think, a firm should do and still be very successful. And therefore they clearly thought about their firm better than I did. So I can't, I just want to hear from a founder of a fund, why they think that this is authentic to their brand and their strategy and how this sustains the excellence of their networks. Because if not, it really is just about dollars and returns and capital. And that's okay. Again, those firms can be successful, but I don't know if they'll be franchised. And of course, there's going to be corner cases where they are. And we'll look back and say, well, they actually got their business right more so than we did as LPs. But it's got to be based on at least that first principles truth of like, why are you doing this? Is it advancing your competitive advantage in the marketplace?
I love the fact that you use the word intentional, because and I'm sure you've done this too, or maybe you got a break while you're in between. It's the fall, so it's annual meeting season for LPs, which means I stopped counting how many we've had this fall, but we have a lot, multiples per week, which is wonderful. We love going to them, and you really get a sense of the tone of the market, as well as a sense of the tone of the GP. And it's, to your point, there is a resonance amongst folks who are intentional in how they build, and for LPs, many times you hear it at the annual meeting if you don't hear it at other times. And you can also see how people work as a team and how they're thinking of not even necessarily always succession, but the training and the passing on the gauntlet. Because I'm teeing up to this question about people are clearly a cornerstone for this, and you're articulating it so nicely. So do we think people maintain or lose franchise status because of the quality of the team? And to your point, you started this whole thing by saying firms are founded by the exceptional firms are founded by exceptional people.
Yeah.
And then how do you inculcate exceptionality or teach exceptionality or hire? I don't know, maybe all of them, but I'm curious about the sustaining. And then when it doesn't work and people do lose their right to be on cap tables. I know I want to acknowledge the truth of it, right? As well as some people maintain it. And so do you think it just comes down to the people and how well they manage talent?
That's a good question, because probably if you gave us a truth serum test to almost every single exceptional venture capitalist, they would say training talent is not what they like doing or want to do. So it has to be about the firm, right? It has to be about who they select into their firm and how they think about talent in the model that feels authentic to them. Like when I joined Bessemer, everybody started working for one partner. It wasn't a pool. I was hired by Bob Goodman. I know the person that was Bob Goodman's VP before me. I know the lineage of the Bob Goodman acolytes beyond me. And, we all joke when I meet somebody who worked at Bessemer, I'll say, well, who did you work for? And that won't seem like a totally crazy question, because what that means is you worked for a partner, you learned their style, which was authentic to them. And then Bessemer's, secret, and I think it's a secret, not a secret, but they hire everyone, at the junior levels and mid levels and then train them up. And then they let them go on their own when they've graduated, and they're given allocation to capital, and they can kind of build their own portfolio. And so, but to go back to your question is that, they've thought about talent at a core level and recognize that their model, they have to acquire and sustain talent that fits within their business model and their governance model. Like, not everybody would be successful at Bessemer, not because Bessemer isn't a great place, not because the firm isn't great, because that model is a little bit more individualistic than a team-oriented model. TCV, by contrast, was a team-oriented model. Every deal had 3 or 4 or 5 people on the deal team. And we took that deal to committee. We talked about it. It went through different stages of a process. And that was a team-oriented sport. And one is more of an individual sport. And I think that, hedge funds obviously operate more individually. Every firm is a little bit different in how they make decisions. And so I think you have to understand sort of what makes things sustainable. And so where you often find things break, to get to your question, is when they change the organizational dynamics of making decisions. And then the talent that they have probably isn't as capable to execute in maybe a different model. Now, that's like a good example is a growth fund or an opportunity fund, right? There's nothing wrong with them in absolute, but it is really about how do you make that decision about, do you build your own team? Is it the exact same team? Do they need to know what a deal looks like for that firm? Can you graft on people with outside experience? Like, that's where the team dynamics, again, if you think about most franchises today, which we could talk about names, they are multi-product. They are platforms. They do have, European offices and European funds and growth funds. And so when I think about that part of like the franchise model, that's where all the kinks in the curve come up, and you got to really think about talent. And I do think the ones who have been successful, look at Excel with Excel Europe, with Excel India, with growth and leaders, you look at it and say, wow, it's a lot of different business units and lines. But I think all the people there, again, were trained in Excel for the most part. They have that, system where people come in and they're able to know what Excel deal looks like, what Excel process looks like, and they're able to then propagate that as they build new products. And you've seen firms shed their, European practices, right? Benchmark had a practice, they had Israel, right? They went back to really, it's still a franchise. So there's a franchise that went up and grew in different directions and then came back to what it felt was its core defining element of success. And so you can go that way and become multi-platform, multi-product, franchise, but that's when the talent, the wall can really come, because, a lot of times they'll open up an office and they'll hire someone from another firm. Well, okay, well, that was logical. You didn't have a network there, but are they going to graft onto that firm and be able to operate with the same sense of success that partners before, right? Bessemer opened up a European office. Alex Ferrara moved over there. The reason being is they wanted to embed that culture in that process. Adam Fisher moved to Israel, opened up the Israel office. Like, you have that, they know India, Pashal. You got to have a way to propagate that. Again, you can do the talent acquisition strategy. It can work. But that to me is around where those franchises end up falling over. because the talent acquisition is then slightly different in how people get things done, and those people will bump into each other. And so that's where culture matters. That's where process matters. But no one ever talks about that.
No, I was
right?
going to ask you, and I think this is applicable for the aspiring franchise funds as well. But let's see when I ask this question. When you're going to then diligence an existing franchise fund, but again, maybe there's an aspiring one that you're looking at, are there key questions you ask to get at some of these nuances? Because my assumption is you're then digesting the answers and saying, what are the odds this is going to end up working out to continue to attract the best entrepreneurs and all that stuff. And I agree, people don't talk about it a lot. It's certainly not in the data room in some, I don't even know what it would look like. So I'm curious what questions you consider, because it kind of gets at how do you spot the enduring franchiseness or the potential for enduring franchiseness in a fund?
It's a good question, because I'm trying to think of like a franchise fund that I diligenced. Again, only been an LP for 4 years, so it's sort of hard to know. Like that was at that kink in the curve, and like what was I asking them, and therefore, and it's too short of a time frame to know whether or not they crossed over to that franchise thing. But if I think about what I am asking for or what I'm asking about, really is around the team side of the equation and how they thought about this expansion and this growth. What is it about this that is compelling? How are you building your network there? What is that different? How does that need to be built differently than maybe the networks back in your home area or your different strategy? Why is a certain person the right person to be doing that? What DNA are you is it offensive or defensive? Oftentimes like that, there's a part of that. Is it part of the market that they're trying to exploit, that they're seeing as opportunity, and they need to win? They need to have, the boots on the ground in order to be successful. It's really those soft questions about the why. And it really does come down to, I use this term in my mind, and I've said it out loud before, is the thought and the strategy holistically consistent with who they are as a firm? That's the word I use. Is it holistically consistent all the way through, from sourcing to execution to team to strategy? And I want to tell myself the story that they've thought about these things first principled. They understand who they are in the market. They see the market clearly. They see that maybe grafting on somebody from an outside background is the right play, because there isn't anybody who can network with those people organically and be able to do that thoughtfully. Or maybe it's, hey, like we are more of a thoughtful go slow strategy, and we're going to plant somebody over there. And it's okay if the first 3 years is non-productive. They're just going to be building a network. But again, that doesn't work if capital deployment is your only goal, right? If your business model is more deploying capital, grafting somebody on is probably the right strategy. But again, it comes with unintended consequences potentially. But versus moving with someone who's like, well, I don't need it to be productive day one. It's okay if it's only a small part of my strategy. So it's got to all make sense all the way through, from fund size to team construction to how it relates back to the mothership, and sort of like those things got to make sense. And it's such a small, hard thing to put a finger on. But if I can't tell myself the story about why it's happening in my mind, and I can't rationalize it. And so I'm asking questions a lot about the why. I was with a fund manager yesterday, and they've got 2 funds. And I said, well, why not just put those 2 funds back together? Like, why not just combine the 2? Like, why do you need a kink in the curve? Like, why do you need 2 funds? You're gonna have this massive allocation strategy, and like, oh, it's a $5 million business and it's growing 100%. Is that a Series A or a Series B? Okay, well, you like, in nomenclature aside, like, what are the criteria that will put it in one firm versus the other? Because on the LP side, you and I would like to say, oh, I should be across both funds, because if for some reason that company becomes the iconic company and they put it in the other fund that I'm not in, well, that's just really crappy that I made a bad allocation decision. But you're forcing me to make an allocation decision. And you're forcing me to pick between 2 different children of yours. And I may like one and not like the other for whatever reason. And that wouldn't be a great reason for me to pass on that fund, because I don't like the fact that I've got to go pro rata between 2 funds. But to you, it makes a total sense because of the fact that you've got these two funds, and the competition for capital could change, where that company goes can change. And so, if you're thinking about it, like, those are the questions that really matter: is why do this? Why do that? How does it perpetuate your flywheels? And again, there's no one way to do it, though, to be clear. I don't want to come across as dogmatic, because that's not the type of LP I want to be, is dogmatic and say never going to do something because it violates some principle. It's just got to be authentic. It's got to be intentional, and it's got to be holistically consistent. And it doesn't mean that's going to be successful, but it's like that's like the minimum viable condition for me to sort of say that these firms can grow in ways and become franchises over long periods of time.
I'm curious then, when you were speaking, what I was hearing was the know thyself, that important statement. And have you ever seen a franchise fund that has endured that does not know itself? It could be, I'd posit it's possible that it's only at the senior, maybe it's up and down the stack, but certainly when they're talking to the LPs, which tends to be oriented around the senior leadership of a firm, not always, but mostly. Do you see this hallmark of them knowing themselves, whether or not they express it to the LPs, but it has to be there as part of the core of it, because if they don't, hitting all these other parts is going to be really hard.
I would have a hard time saying it's a franchise fund if they're not able to define, that not have to be very clear about what their strategy, right to win, how they approach it, all the different things that you just mentioned, because it's a competitive market, right? There's lots of choices. And if you can't articulate that, like, think about it, I just joined Adam Street, right? And I joined this franchise, right? We can use the franchise in the case of Adam Street. I'm curious one day offline, not on mic, what your view is, but I come into this franchise. And do I feel that I have an intentional view of how we go to work every day? And I do. And I felt that at the Packard Foundation. Like, it was very clear from all the pieces and parts of what it meant to be at the Packard Foundation. So even just extracting being a VC, successful firms that endure, franchises outside of everything, have that encoded. And again, it can change, though, to be clear, right? The generational transition can create a change in the strategy and the evolution of the firm because the new leadership is coming in theory, and the market's changed, right? It's sort of like, well, the market shifted. Here we are. Someone else is now maybe taking over the reins, and they may be charting a totally different course. And that may mean that they have to change the team and the strategy and the org. But if you just say, like, well, they're a franchise, they made the generational transition, they're at fund 9, and they have no clue how they get to fund 11, 12, 13, then they haven't thought about it, and I think great leaders do think about it, even if they're not like, having one-on-ones and sessions, and offsites. Like, there are people who are obsessed about thinking about their firm. And I've seen it, it's across asset classes, right? It's not separate to venture. Buyouts too. The best buyout managers have thought about it. Hedge funds are the really funny ones because, it is a little bit of a single trigger puller model. And so, like, you could argue, are any of them franchises over long periods, because eventually that senior principal leaves. So they're good examples of firms that have made that transition on the hedge fund side. We could save that for another podcast, but that's in and of itself an interesting dynamic because it's such a single trigger puller model. But that's not partnerships. Partnerships ultimately are multiple decision makers making decisions. And so, yeah, they've thought about it. And I think that's why solo GPs can be franchises, because they think about their brand all the time and they think about their right to win. And so it's, in some ways, it's almost easier because you don't have to go through the generational transition. It's just you. But they probably thought about it. And I don't think any of the solo GPs are or aren't franchises yet. But, and maybe none of them will be. And that would be okay because they still could have great returns. They don't need to shoot for that. If I guess in some ways, the likely condition for a solo GP is not to become a franchise because they don't have to think about generational transition. But if they're going to be fund 9, fund 10, then they're going to be a brand in the market. Yeah, sure. But like, I think the jury's out, like where those will go. But if I were looking at a fund 3, fund 4, fund 5 today, and I was thinking about putting money behind it, I would be really focused on the why of what they're doing and how they think that what's their competitive advantage and how that either grows or doesn't grow over time and where they want to play.
Stephen, thank you so much for coming on. It was fantastic covering this topic with you. And I look forward to future pods and we can continue to track the market.
Thanks so much. I really appreciate it. I'm really glad I got to do this first podcast with you, Beezer. Thank you.
We love it. We love being your inaugural one. Have a good day. Thanks for listening to Origins, the show where we discuss the venture ecosystem through the lens of a GP and an LP. Although in this episode, what you got was 2 LPs. Be sure to tune in next time for a bonus minisode where I'll unpack today's conversation with Stephen with the help of a special guest host, my partner at Sapphire Partners, Laura Thompson. You can find that right here in this feed. And while you're there, please rate and review this podcast. It's super helpful for us to hear from you all on what you like, what you don't like, and ideas for future episodes. I'm Beezer Clarkson. On behalf of my GP co-host, Nick Charles, and I will be back soon. Thank you for listening.